it thereafter. Those of you who are new, who are just coming into the market, who have perhaps not really pay much attention to your market, is that what you're doing is to look at the market from a higher time frame and then to return back to a lower time frame. Okay. And so that when you are making a decision to find an entry to the market, you know exactly why you are doing that. Okay. So what we've done is that we've ascertained, first thing I always tell people, two major important things that happen in the market that you always need to pay attention to. Forget about those big English people are speaking about trading. First, you want to look at where is the market going to? Where is it coming from? And when somebody say higher time frame, it all depends on what you are doing. If you are trading, if you're scalping, your higher time frame practically is 15 minutes. Just need to know that. You are a scalper, your higher time frame is 15 minutes. So that means you're going to be looking at the sell side and buy side liquidity, right? Your trading zone range is 15 minutes. So you want to look at, but as a day trader, as an intraday trader, you want to look at, daily time frame, fine. Quickly, you are not going to waste too much time there. So where you can now have much time to look at, to mark out some important point or pivot point is on 4 hours. And then you have done that. So we have done this, and all of that. We already know that tentatively, because this candle has closed on 4 hours, tentatively, this is an up. So whereby if the market refuse and return back and break this, then that means it has broken it and retest, and you want to get out of, find a way to buy, gold, as it were. So now step down to one hour. Most time, the refinement of 1 hour and refinement of 1 hour and 4 hours, they're almost similar. Okay, they're almost similar. Now, for somebody who is a kind of swing trader by now, right, is looking at the market is actually reacting to this point, because this is just like a point at the market stop, and then you want to look at it. So as a person now who want to look at the 1 hour time frame, you're going to see that this is swing low and then this is swing high because the candle has closed, right? And then you want to look at, I'm going to take my Fibonacci retracement. Perhaps if this market is going to continue, where am I expecting it to get to before continuing? So perhaps that's where you are now looking at, okay, the retracement level, but this is extremely bullish. So don't get it wrong. Sometimes the pullback you are expecting will be very shallow, and that's why you have 38 retracement level. So most time you expect a very big pullback, and it will never happen. And most time people are like, oh, okay, just imagine you're expecting a very big pullback here. So let's take off this so that you understand different perspective and different concept of the what's it called? The market activity. So look at it here. This is a pullback. Now, where did it pull back to? Not even up to 38, because it was extremely bullish. Now, you're waiting for it here, never did. Then you need to pay attention to the candlestick to know if the market, that was just a shallow one. But if you look at it inwardly, what makes this market for you to even actually react to take a trade when it refuses to return back to maybe 50% replacement level, or 61% replacement level, or in between, which is a golden zone? Is this point? Look at the high here. Look at the high here. So this high was actually, gotten penned on. And so for that, you expect a bounce. For the fact that you expect a retracement back down here, because taken from this low to this high, you expect it to actually return meaningfully, but it didn't happen. So you are paying attention. I always tell people, when you are trading, look at the left-hand side. So now, tentatively, this market is dangerous, right? Now, somebody could short this market, right? Somebody could short this market, expecting this market to hit down here before taking another bounce. It may never do, because it's extremely bullish. So in other words, that means you are looking for more of buy. But if you are going to look for a sell, it's going to be very like you are playing with it. Maybe I look at the market I did here. Let me check it. I think just like you are playing, right? Maybe small pips, small lot size and all of that. Look at this one, was just like how many dollar being made. Like you're just playing with the market. Okay, $2 so far, because look at it. This is on 15-minute time frame. Even look at, it's still above your 50 moving average, which means it's still bullish on 15-minute time frame. Okay, so that you don't jump into the market and you're now, oh, what do I do now? Oh, when do I move the market? Should I move this here? Do I not move here? And all of that. All right. So let's quickly go very fast. So we are supposed to short, right? But because the market is extremely bullish, so let's look at what we're going to do. So we find a level here. We find a level here. So we find a level here. Then we find a level here. So let's step down to 15 minutes perhaps, right? Because well, if you go to 30 minutes, just going to be similar to 1 hour, what to find there. So I'm going to go to 15 minutes, which ordinarily is supposed to be your entry level, perhaps, all right? If you're an intraday trader, supposed to be your entry level, 15 minutes. Now, the question you ask yourself is that the way gold is now, what should I do? Gold is still bullish. The pullbacks is not even encouraging as it were. So that means gold can bounce from at any point now. So it means selling gold is much risky. Okay? Selling gold is much risky, just like what you had here, and just inducement. This is an inducement and all of that. The same thing is happening here. So the next action that will happen may be one powerful, strong, engulfing candle. And then before you know, just break out of this point. Remember, that was what we're waiting for. I told you guys, I said, just set your market. Perhaps we expect a pullback, but if you never do, no problem. But if you pull back, you can take some entry, and then you can see how the market ride up as fast as possible. Now, for anyone who actually entered the market at that point when we sent it over here, and probably maybe hold it, that's about 410 pips to the 33, 36, 35, that's 310 pips as easy as possible. Okay, so now let's go. So what are we going to do here? We're in 15 minutes. So now I'm refining down to as low as even 5 minutes, even 1 minute. Now look at it. This is not a market that is set to go down. All right? This is not the market that is set to go down. It's extremely bullish. If not, ordinarily, this market, this is a liquidity, this is a liquidity, this is a liquidity, and all of that. You should be looking at gold, even if you cannot come back to this point, you should be looking at gold at all of this point, and all of that to the last point here. Okay? So this is the play we're supposed to be looking to buy gold. So to be safer, you probably want to wait for gold to actually retrace here or here or here. But for risk takers, they will have sold from here because the market was just dialing and it has been long overbought, right? But as a conservative trader, you wouldn't take such trade because gold can bounce from where it is now. But the good thing is that look at when you are trading, the candle pattern, the candle you are looking at, even though they are slow and weak, but we are having more of up-close candle, which invariably confirm again that the market should be going down. But selling gold now is risky for me and you. So what am I supposed to be looking at? I should be looking at all of this point as liquidity level, right? All of this point as liquidity level down to this point, like this as another block, for instance, that had not been tested. Okay? So that means it's better for me to wait for gold to actually pull back than to jump at it that I want to sell. Okay? So you have to be very careful because here, the gold can bounce from any point at this or can return back here. So that means for anyone to have wanted to sell, you will have entered earlier than this. So in a nutshell, we can't find entry on gold because it's extremely bullish. The pullback is so shallow and it's not making any massive move. That's are the issues. Okay, so let's quickly now take any instrument we can. I think Euro USD is still pumping, and then Euro USD is still pumping. Okay, most of you too traded, those of you on our Signal group, many of you traded this thing, and I'm sure you were afraid. I gave Signal in the morning, right? When we took this trade down. And on our Telegram Signal group, there was a message I dropped there. It was very simple. And the message was this. I just hope I can find it. All right, so let's go. And that's why trading is mechanical, and then you just need to be patient and follow it mechanically. Okay, this was the message I sent here. As a second entry could pull back to the M15 FEG, that would be your DCA at the level of 200.123. So here, that the market was going to come down. But before the market actually, because the market actually returned back to this point, guess what? It has delivered much money. That of average of, let's look at it, about 50 something pips. That was crazy, right? About 50 something pips had already been delivered. And I told everybody who were on the group, I said, this is 15-minute FEG, that the market was going to return back to this point, and that will be a DCA for you. So meaning, fine, you will have taken some profit. And then if you're in the market, yeah, this is a massive reversal. And then getting to this point was a point of interest for you. And then we're looking at. So this market is slow, however, this is still going to sell. Even if you are looking at 2, 3 major places now, this is a key level, right? But this is a liquidity level. Market respect very, very strong level, liquidity level, as it were, right? So that is to say, this is a liquidity level. All these are gaps, and they have not been filled. So probably you expect them to be filled up to this level. This is a liquidity probably traveling down here. Okay, so that means this market, if you want to like maybe just to try your trading skill, you can take maybe 0.01 on GBP, GBP JPY like this, GBP JPY like this. Okay, GBP JPY. And I told some of us who are new, who do not have money to start trading, I said, okay, I even entered this, or I sent it again to somebody, perhaps, because I was telling them that the market was going to bounce or return back here and then find an entry, and all of that. So I said take 0.001 as, maybe just a conservative trading and all of that. So I short the market on GBP JPY. Is being short already, all right? So now this is another issue. Most time when you are trading, there is no definition of your trading. Like this trade now, if I'm taking this trade now, right? And I purposely take it so that I can teach you something. As I take this trade now, do you know it's wrong? Now, because why? I always tell people when you are where you are taking trade from, where is going to be your stop loss? So imagine I take trade from here. Where should be my stop loss? Where ordinarily my stop loss is going to be in this immediate swing high. Okay, so if I took the trade here, so my stop loss is going to be above this swing high. Now, but look at it. Where 1:2 risk reward is my minimum target. So my minimum target, 1:2 risk reward, that means I will be targeting here. So where does it actually align with? Well, fine, align with this gap and align with this liquidity. So if it's gonna sweep this liquidity, but there's a liquidity here that can be swept. So that means if you look at it here, let's look at it to this point. That is about 1:1 point something risk reward. So I will target there, and then where if the market actually get there and start doing, I will break even. These are things you must always ask yourself when you are taking an entry. We have taken an entry, the trade is running, right? I ask you to take an entry. So if you have not taken, take the entry. Now the trade is running. Now, the best of my trade, the best of this trade will have been where I told everybody that the market was going to travel back up to this point. And then for the fact that we expect it to travel back to this point, it's not a yardstick for you. Yes, some can actually set, because sniper entry trading means I will set my trade, right? My stop loss will be very insignificant. Let's take an example. My stop loss is going to be very insignificant. And there's a way I trade this, an imbalance. This is the way I trade it. So I'm going to take my gun box and I mark from the high to the low to, now I DCA. How do I DCA? Now, very important because trading is mechanical, right? Now, how do I DCA? Okay, my intention, let's go to babypips.com. And if you are not doing all of this I'm mentioning, you are just gambling. So let's go to babypips.com and we go to position sizing. Anyone who is effectively trading don't have time. Wouldn't want any distraction from anybody because you want to be doing the right thing with your trade. Okay. Okay, let's go to babypips.com. Okay, somebody is saying something. Let me check. Okay, you use opportunity to address the chat I sent, referring to. Oh, okay, you sent a chat. Okay, I will check it. So now let's go to tools on Baby Pips, because this is your business, man. So let's go to tools and we go to position sizing. This is your business. You have to address it as your business. I'm always interested in imparting people the knowledge. I know most persons, they always want, yeah, signal is good, right? Yeah. But I always want my mentees to have confidence in building their signals. Signals is the simplest thing. Most of the signals people always even look at somewhere, they are funny signals from different groups that they don't even do the proper analysis, and then you hit stop loss. Now, if you are building a prop firm, let's use a practical example. We have said that if you do not have enough money, even if you have enough money, scalability in business is very important. And if you're trading Forex, for instance, or you are trading this market, when you have access to reasonable fund, it's an edge for you. That's the truth. Because you know why? The same analysis you use and analyze to enter money of $100 is the same analysis you will use for $200,000. Now, so instead of me struggling with $100, I'm not saying it's bad to be trading with $100. So understand, because you are going to be using 0.01, you take one position or whatever. Now, I've done this before, and so pay up attention. If you are trading with $1,000, your personal money, they always say risk 1% of your money, or risk 0.5%, or risk 2%, or risk 10% of your money. It all depends. They are not fixed. If you are trading with $100, you can use 1% of your money. 1% of your money, for God's sake, is $1. So you might have to increase your percentage. So that means you are going to expose your money to more risk. Maybe you'll be thinking about risking 5%, which is $5, or 10%, which is $10. Okay? So that if you lose that, you see. So that means your $100 have lifetime of about 9 times. If you take succession of trade up to 9 times and you fail, then forget about that money. So now let's go. Let's say I'm trading a prop firm of $25,000, traded mastery, for instance. Now, your daily drawdown is 5%. So 5% of $25,000 will be how much? Will be $125, if I'm not mistaken. Let's quickly look at it. Okay? Right? 25,000 multiplied by 0.05. Okay, so that's about $1,250. So I'm going to put that here, $1,250. Now, and I said, if you want to be very conservative, just tell yourself that this is the money you are trading with. And now you are going to be exposing 5% of that to trade, 5 to 10%. Okay? So 5 to 10%. So if you 5%, that means you can do 20 times of success, losing back to back up to 20 times, rather, up to 20 times for this money for you to hit your daily drawdown. So now, what's my stop loss? Now, your stop loss again now determine how many lot size you're going to use. So let's say, now for those of us who are using Beckernet, for instance, Beckernet use 80 pips. But I tell you, if you are a swing trader, you can think about from 100 pips to 150 if you're a swing trader. If you are a day trader and it's currencies, or you can do 30 pips, a day trader. If you're a scalper, you can do 10 to 15 pips. But I can tell you, even if I'm as a swing trader, I still refine my market to the extent that my stop loss will not be as big as you that you are even scalping. But let's pick it to 50 pips. Okay, let's take the average, 50 pips. So by 50 pips, let's calculate. So it means on 50 pips, They said per trade, what you are going to expose to the market, if you want to expose 5%, is about $62.5. So let's wrap it up to about $65, right? So that means the total lot size you should use is 0.125. Oh, 0.125, no problem. So am I going to take this? So let's divide this thing into 2 or 3. 0.05 in 2, that's 0.1, then 0.25. So 3 positions. So that means very simple. What am I going to do here? The simple thing I'm going to do here is this. Since I have entered from here, I'm going to enter, instead of 0.125, I'm going to split into 3. I can enter 2 at a go, 0.05, 0.05. And then the remaining one, I'm waiting because the market, when you have entered, the market could pull back, especially when it just broke structure. If a new break of structure, it will pull back. At that pullback, you enter the last one. Now, if it didn't pull back, like what if you do what gold did, rather than pulling back, it continue. Now, the next pullback may not come back to that place you're expecting. Let me just go to gold and show you example. The trade we took in the morning. Now, when we took that trade in the morning, the candle was pushing very fast. Now, so we expected the pullback to hit down here. It never did. And it did a very shallow pullback. A very shallow pullback was what it did, which was here. If you go to 5 minutes, you could see the pullback easily. So a shallow pullback was what it did. And I told everybody, fantastic. It was a very good pullback because after that, look at an engulfing candle. And then that means you are now taking the last entry into it. And as simple as that. So with that, you have entered the market and then the market is now running. So as the market is running, just like what we have done on GBP JPY. Now on GBP JPY now, for instance, we have entered. If you pull back, you're going to now put in the next one. But like I told you, I said my own entry is usually very refined. So imagine when I'm targeting here and I said the market was going to come here. So my 3 position, one will be at this 0. At 1, 0.5, and 0 level. So, but altogether, let's take the average that I'm now taking an entry of this market at this point. Now, so where should be my stop loss? Of course, the candle that created that fair value gap, which is here. So that means my stop loss is going to be just shortly above here. So sometime I may want to be very conservative. I'll push it up a little, right? As I push it up a little, look at what has happened. Very simple. Now look at what has happened. How much is my own stop loss? 12 pips. So I've reduced my stop loss to the barest minimum. If I'm going to take 1:2 risk reward, here will have given me, that means 24 pips. Now, because I've taken maybe 2 or 3 positions, and that's a 1, stop there and give me my profit. The other one, I may target here. This liquidity down here. Now, targeting there, that's going to be 1:5 point something. Okay? And that's going to give about 74 pips. Then I still now see that there's a gap here that can be filled. I take the next one there, or perhaps I will not even put anything there. I just adjust my stop loss. Because at the end of the day, when this market move, and then I've taken my maybe first take profit and adjust my stop loss, where am I going to adjust my above this point? Not just following the market. At the end of the day, you see that this market will deliver to me 1:10 risk reward. 1:10 risk reward, which means I'm risking just 12 pips and making 137 pips. Now listen, in that case, since my stop loss is very small, the pips is very small, what am I going to do? I can just increase. Of course, your lot size you have put again and all of that. You have measured the whole thing and all of that. You can just increase it as it were. Maybe you are stacking more because you are able to reduce, your stop loss to barest minimum. Okay, so at the end of the day, you see that, the market have delivered to you as much as you want to do. Okay, so let me look at the chart you say you sent to me. So we're in a position on GBP JPY. So if you are just coming in, we short GBP JPY. We say gold is dangerous for you because it's still an uptrend. Let's go there now. It may be bullish. Okay, look at the thing it's showing. So gold actually need to massively move, or if not, you are going to destroy your account to be shorting gold. So better still, you want to look at what gold will do or when market open. Funny enough, market can open because you have 1 minute break or how many minute break, about a 1 hour break from 10 to 11 p.m. All right. And the market opens, it can come and sweep this as the high of yesterday, that's high of today, and now sell down to this point, all right, to hit here, or come to take this liquidity and see travel back, as it were. So that's why when the market is not too clear or it's an excessive bullish and you want to correct itself, then you just avoid it, not to entangle yourself. It's very, very important. Okay, so let me quickly look at what to say you sent to me or on the group, the charts. Let's quickly look at it. Okay, good evening. Looking at the above diagram, I was of the opinion that market will recover the FEG selling, but reach the middle considered to be equilibrium. So market return to buying. Could this scenario not play out when market resume by 11 p.m.? Is this not abnormal? Okay. I was still holding this trade with a drawdown. Hence, my stop loss was not reached. Now, well, now let me now make you to understand. If this trade, you are holding this trade, if you short in the morning, and is that short you head in the morning that you are still holding, you are wrong. Why? Because the market travel well and give some profit. You were supposed to book some profit. Fund number one. Number two, either you book profit or not, then when the market return back to that fair value gap and rejected, you are meant to load another section into it. With that volume, as the market has traveled to this point, now listen, this is the dynamics of your trading. The dynamics of trading is this. You have entered the market, so that's why your initiative you are using, there's an intuition. The market has delivered very well and give you more than enough money. You are giving more than enough money, but you discover that the market is drastically pulling back, okay? And you're already in profit because you have DCA. That's why I don't trade just one position. One or two out of them ought to have closed in profit. Then the other one will continue to follow to the extent when the market return back to, because you already have an idea that the market was going to return back to that FEG. Now, having returned back there, that makes a lot of sense. And then that means the market now want to continue traveling down. Then you are loading new one. Remember, you have collected the first money. The new one you load is like a risk-free money. But let me tell you one thing. Most of us have this problem, not able to do this, because you probably may be looking at different markets at a time. You are looking at gold, you are looking at GBP JPY, you are looking at Euro SND, you are looking at Euro GBP, you are looking at Bitcoin and all of that. To be very candid, you are going to have issues. What I do, when you come to the market in a day, you have on your watch list 1 or 2 or 3 or 4 or 5 instruments. At a glance, anyone that don't give me clear direction at a glance, I just abandon it. I go to the one, I need the one that is trending so that I won't struggle my trade. My price delivery, I want it fast. So I have to take the one that is trending. So if it's 1 and 2, those are the one I'm going to check for that period. If I'm trading in London session, that's the one I'm going to check for that period. I'm not going to check any other one so that it won't distract me. Very, very important. So that at the end of the day, it will deliver maximally for you. But if you want to check that one and you want to correct the other one, you won't maximize that particular instrument for that time. So imagine if anybody was trading this now, having short, and the market was moving, when it was drastically moving, right? Even when it was now saying, oh, I'm pulling back because I want to go back here. Do you know that I will long it? Do you know that I will buy? Even I will have position that is still running because, of course, some of the exchange you can hedge. So it will be like as if I'm hedging, but I'm not actually hedging. Do you know that I can buy because I've discovered that, okay, it's now taking that reversal. Okay, let's reverse. I already have an idea where it's going to get to for the reversal to be over. Then I will trade back to that point. And so imagine from this point, after this engulfing candle, from here to this point, come on, this is another 59 to 60 pips. That's crazy. So this is the dynamics of trading. So when you are trading, you are in charge, and then when opportunity open up, you grab the money and then work with it. But if you have too many instruments, you will not be able to grab it like that. So that's one of the things. So, but gold was printing money for us now. So that's where you were distracted about it. So because if any of us don't make money on gold today as much as possible, that means an enemy must have done it. Okay, so ladies and gentlemen, thank you. This is so far we can have tonight. And then if you are yet to be in our inner trading forum, make sure fund your account on Capitalxtend so that you can come there. And then if you have not subscribed for your Beckonet software, we are doing a lot of things on it and it's quite amazing. So it's going to help you a lot and all of that. So ladies and gentlemen, we've told you to scale your trading fund, go for prop firm. Instead of struggling with $50, $100, buy prop firm, sacrifice, build it. You can take time off. If you used to go to friends, tell them I'm on holiday. If it's 1 month, 2 months, 3 months, 6 months, you want to take to do that, build it.